5 states are quietly siphoning off $4,000 or more in home equity from older homeowners year after year, and almost none of them realize it is happening until a notice lands in the mailbox or the deed is already gone. This is not a property tax, it is something else. It is a hidden equity transfer that has been in motion for decades in some of these states, and a Supreme Court ruling in 2023 only shut down part of it. The rest is still happening right now in every county across these 5 states. And in 2 of them, it is about to intensify. This year, you may have spent 30 or 40 years paying off a house. Your name is on the deed. The mortgage balance is 0. You assume the equity inside those walls belongs to you, but the rule that decides whether you keep that equity is not sitting in a federal law book. It is written county by county inside obscure state tax codes that were drafted before most of you were even alive. And in the 5 states I'm about to cover, those codes still allow the government or a private investor operating through the government to walk away with tens of thousands of dollars in equity that you spent your entire working life building. There is one document you can file at a county or town office for less than $75 in most areas that quietly stops the worst part of this process in 4 of the 5 states I am about to name. I will explain what it is before this video ends, but only after you understand which states still keep this rule on the books and why seniors with paid-off homes are the ones standing on the trapdoor. The rule does not go after distressed owners with no equity. It targets those with the most value to capture. That means the seniors who did everything right are standing in the path of the biggest losses. Let us start with the case that brought the entire system into the light. A 94-year-old widow named Geraldine Tyler owned a small 1-bedroom condo in Hennepin County, Minnesota. She fell behind on her property taxes. The full amount past due, with penalties and interest included, was about $15,000. Hennepin County took the condo, sold it for $40,000, kept all of the proceeds, and gave Geraldine Tyler nothing. No refund, no partial payment, no leftover balance. The county seized $25,000 of her equity. Equity she had accumulated over years and labeled the taking lawful under Minnesota law. For a long time, courts in Minnesota and in several other states said this was completely permissible. Their logic was that once you default on taxes, you forfeit the entire property, not just the slice equal to the unpaid tax bill. So if your house is worth $400,000 and you owe $10,000 in back taxes, the state could grab the entire property and keep all $390,000 in equity. So, Geraldine Tyler filed a lawsuit. In May 2023, the United States Supreme Court issued a unanimous opinion in Tyler v. Hennepin County, ruling that this practice violates the Takings Clause of the Fifth Amendment. The Constitution says the government cannot take private property for public use without fair compensation. Confiscating $25,000 of equity beyond a $15,000 tax debt is, in everyday language, stealing. But this is the point where most readers exit the article and never see the rest of the picture. The Supreme Court did not ban property tax foreclosures. It only said that any surplus, the equity above the tax debt, must be returned to the owner. So the seizure still can happen. The auction still can happen. The house can still be lost. The only change is that the county now has to send you a check for whatever remains afterward. And that is exactly where the next layer of problems starts. In Minnesota and 4 other states I am about to list, the details around how that surplus is computed, who is told about it, how long you have to claim it, and what costs are subtracted before you see a dime are still being drafted. Some counties impose administrative charges of 15 to 25% before any surplus is forwarded. Others require the owner to file a separate court claim to collect it. And if the senior misses the filing deadline, sometimes as short as 90 days, the surplus can legally revert to the county anyway. So the federal court stopped the most extreme form of equity theft. It did not stop equity erosion. A $4,000 hit to equity from fees, lapsed deadlines, and procedural traps is still routine in tax sales throughout these 5 states. Even after the Tyler ruling, Minnesota itself revised its tax forfeiture law in 2024 to line up with the Supreme Court. Surplus proceeds are now kept in a state account and the previous owner can file a claim within a set time frame, but the claim form is not automatic. The county must send you notice, but that notice goes to the address they have on record, which for an estate going through probate or for a senior who has moved into assisted living is often outdated. So the letter gets mailed, the clock runs, and the surplus remains with the state. This is the same pattern in all 5 states. The federal court locked the front entrance. State lawmakers left a side entrance wide open, and the people walking through that side entrance are the ones who understood the rule from the start. Mostly investors, rarely the senior whose equity is sitting in limbo. A 2-minute phone call to your county auditor asking whether your name appears on any surplus report from a tax sale in the last 2 years resolves this in Minnesota. But it is exactly the kind of call almost nobody makes because almost nobody realizes it needs to be made. Now, shift from Minnesota to Nebraska, which had one of the strictest equity stripping systems in the country before Tyler. The state used a tax certificate sale structure that let private investors buy a tax lien, hold it for 3 years, and then apply for a tax deed, transferring the entire property to the investor. The original owner could redeem within that 3-year window by paying the overdue taxes plus interest at a statutory rate of 14%. So a $3,000 tax bill could grow to more than $4,500 before the redemption period ended. In one heavily documented case from the late 2010s, a Nebraska owner lost a house valued near $200,000 over a tax debt under $6,000. The investor captured all the equity. The owner got nothing. After Tyler, Nebraska modified its laws to require that any surplus be returned, but the certificate sale system itself is still very much in place. Investors continue to buy tax certificates and collect statutory interest. The senior owner still faces a redemption timer the moment they fall behind. The only shift is that if they fail to redeem and the deed changes hands, the investor is now legally supposed to send the surplus back to the prior owner. But how that surplus is calculated is where the $4,000 figure shows up. Nebraska law generally allows both the county and the certificate holder to subtract what are called recoverable costs from the surplus before payment. Those costs include lawyer fees, title searches, recording charges, and the statutory interest that accumulated during the redemption period. In most Nebraska counties, those subtractions average from about $3,500 to $4,500 per case. So a senior due $20,000 in surplus equity might see only $16,000 or less when everything is taken out. That is not illegal theft in a strict sense. The Tyler decision does not bar reasonable administrative expenses, but for a retiree on limited income, $4,000 in equity evaporating into fees can decide whether they afford a year of in-home help or must rely on a state nursing facility. So, the real shield in Nebraska is informational, not strictly legal. The state obligates certificate holders to send notices at several points, but those notices are written in dense legal terms most seniors do not understand. They resemble junk mail. They get thrown away. The redemption deadline passes. The deed changes owners. A licensed real estate lawyer in Nebraska, charging around $250 to $350 per hour, can look over those letters and tell you in about 15 minutes whether your property stands in danger. That $50 to $90 consultation can stop the $4,000 surplus haircut and sometimes prevent the complete equity loss if the redemption window is still open. Nebraska also has a specific filing known as a homestead exemption that, for homeowners over 65 with relatively low income, reduces the taxable value of the home, or, under some county programs, postpones the property tax bill until the home is transferred or sold. The postponed amount becomes a lien against the property, but this lien is junior to any first mortgage and does not accrue interest at the higher statutory tax rate. This means a senior who cannot comfortably pay property taxes can apply for the deferral, avoid a certificate sale altogether, and protect the home's equity. The homestead form is submitted to the county assessor, usually at no cost, and can be completed in a single visit. Yet very few eligible Nebraska seniors use it because almost no one tells them it exists. Their adult children do not know. Their tax preparer does not know. The county assessor is aware but is not obligated to bring it up. So the application goes unused while certificate sales continue around the state. Now move east to New Jersey, where the rules differ, but the equity drain is even bigger. New Jersey routinely posts the highest effective property tax burden in the nation. The typical homeowner in counties like Bergen, Essex, and Union pays between $12,000 and $18,000 annually in property taxes on a single-family residence. For a retiree who paid off a mortgage decades ago, that annual bill is often the biggest single cost left in retirement, surpassing even health care for many. That is the backdrop. Now consider the fallout when a senior in one of those counties cannot keep up. New Jersey uses a tax lien sale system, similar to Nebraska's, but with one critical difference. The interest rate on an overdue tax lien in New Jersey can climb as high as 18% plus a 6% penalty on the original delinquent amount. So a $5,000 unpaid tax bill can balloon to more than $6,500 within a year and to more than $10,000 in 3 years. But the larger risk in New Jersey is tied to what is known as the abandonment doctrine. Under New Jersey law, if a municipality labels a property as abandoned, the lien holder can bring a fast-tracked foreclosure action that shrinks the redemption period from 2 years to as short as 45 days. The criteria for abandonment are broad. A senior who moves into assisted living and leaves the house empty for 90 days while the family decides whether to list it can have the property tagged as abandoned by a code enforcement official, and the foreclosure timeline speeds up dramatically. In a typical New Jersey tax foreclosure involving a paid-off senior home, the surplus due after Tyler can range from $20,000 to $50,000. But the allowed write-offs under New Jersey law include attorney fees that, in these quick foreclosure cases, often total between $3,000 and $4,000, plus lien interest, the statutory penalty, and the town's administrative cost. The $4,000 equity loss in New Jersey is almost guaranteed. So the smartest protection in New Jersey is proactive rather than reactive. There is a New Jersey law called the Senior Freeze, previously known as the Property Tax Reimbursement Program, available to homeowners 65 and older whose household income falls below a specific cap. That cap is updated annually by the Division of Taxation, so you must check the current limit before applying. The Senior Freeze does not erase the entire property tax. It locks your tax bill at the amount you paid in the first year you qualified, and the state refunds you for any increase in later years. So if a senior's property tax climbs from $12,000 to $15,000 over 5 years, the state sends a reimbursement check for the $3,000 difference each year. The Senior Freeze form is filed with the New Jersey Division of Taxation with no filing fee. The catch is that the application has to be submitted every year. Miss 1 year and the freeze resets at the new higher level. So a senior who qualifies in year 1 with a $12,000 bill and forgets to file 3 years later will see the freeze reestablished at the higher tax base, often $2,000 more. There is another catch. The state issues the reimbursement, not the town. The municipality still sends the full tax bill every year. You are required to pay that amount, and then wait for the state to reimburse the difference. For a retiree on a tight budget who cannot front that cash, the program becomes practically unreachable. As a result, the senior keeps paying the increasing bill until they cannot, falls behind, and the lien sale process begins. A New Jersey elder law attorney charging $300 to $450 per hour can review your property tax record and senior freeze eligibility in one meeting. The cost often lines up with roughly 1 year of reimbursement, so the financial benefit shows up almost immediately. Now move west to Illinois, which, before Tyler, operated one of the most aggressive tax sale equity stripping systems in the United States. The state used a mixed certificate and deed sale structure where investors could buy tax certificates, collect interest at rates reaching the high double digits in some counties, and convert those certificates to full ownership after a redemption period. Cook County, which includes Chicago and holds the bulk of Illinois property values, was the center of these practices. In multiple well-reported cases, Illinois owners lost homes worth from $150,000 to $400,000 over tax debts as low as $4,000. The investors ended up with the entire property. The owners received zero. After Tyler, Illinois updated its tax laws to require the return of any surplus, but homeowner advocates have criticized the changes as insufficient. The Illinois law typically lets certificate holders recover collection expenses, lawyer fees, and statutory interest before the surplus is passed on. In Cook County, the standard deduction amount in a post-Tyler case falls between about $3,800 and $5,200. So a senior owed $30,000 in surplus might see only about $25,000 after deductions. That is the $4,000 equity cut in actual numbers. So, the main defensive move in Illinois is the senior citizens homestead exemption, available to homeowners 65 and older who live in the home as their primary residence. The exemption reduces the equalized assessed value of the home by a fixed figure that differs between Cook County and the rest of the state. The real tax savings depends on the local rate, but often lands between $400 and $700 per year. However, the stronger protection is the Senior Citizens Real Estate Tax Deferral Program. Under this program, an Illinois homeowner over 65 with income under the annual limit can postpone property tax payments altogether. The postponed taxes become a lien on the home at a low statutory simple interest rate, and the lien gets paid when the home is sold or transferred. This deferred lien stands behind any first mortgage but ahead of unsecured creditors. So the senior never falls behind, never enters a tax sale, and never loses $4,000 to surplus deductions. The deferral form is usually filed with the county treasurer early in the calendar year. The filing fee is generally zero, but very few eligible seniors in Illinois make use of it, mainly because the program is poorly advertised and many older owners assume deferred taxes will cause future headaches for their heirs. The reality is the opposite. The deferred lien, at a single-digit statutory rate, is far cheaper than the steep interest charged on unpaid tax liens, and it is structured to be cleared at the time of sale or inheritance with no surprise penalties. That means the deferral protects the retiree while they are alive, and also shields the heirs from a forced tax sale at auction. There is one other Illinois-specific issue worth pointing out. Cook County offers a separate disabled veterans standard homestead exemption that can lower the equalized assessed value significantly for veterans with a service-connected disability rating above a certain level. The exemption often can transfer to a surviving spouse, but it usually requires yearly recertification with the county assessor. The renewal form is mailed to the address on record, so the same address change problem we saw in Minnesota appears again. A senior who moves into assisted living and fails to open that mail can lose an exemption worth thousands per year. A licensed Illinois elder law or property tax attorney can assess your qualification for all 3 Illinois programs in one appointment. In many cases, the cost of that meeting is repaid within the first year of properly filed exemptions and deferrals. Now shift east one last time to Massachusetts. Massachusetts is the most active state in this group because the fight over equity and property taxes there is happening right now. The state has had a long-running property tax cap law called Proposition 2.5, which restricts annual property tax increases to 2.5% plus additional revenue from new construction. For many years, this cap shielded owners from runaway tax hikes, but recently, a number of Massachusetts towns have begun working around Proposition 2.5 using a mechanism called an override vote. An override is a ballot measure asking local voters to approve higher property taxes above the cap to pay for a specified project, often a school, emergency services building, or major infrastructure work. In many Massachusetts local elections in recent years, override questions have passed with a majority vote. That pattern drew recent national coverage because it means that in any override election, the probable result is a higher property tax bill. For a retiree on a limited income in a town where the override succeeds, the annual tax can jump by $1,000 to $4,000. So the equity loss here is not theft in the Tyler sense. It is a gradual leak through yearly tax increases that the senior cannot vote down alone because they are outnumbered. But there is another Massachusetts proposal that is even more worrisome. Several communities have started to talk about what is informally described as an unrealized equity tax, essentially a property surcharge on the amount a home has risen in value above its original purchase price. The structure is being modeled on proposals floated in other regions. As of early 2026, none of these unrealized equity taxes have been enacted in Massachusetts, but the debates are active in town meetings and legislative hearings, and homeowner groups are monitoring them closely. If an unrealized equity tax were adopted in even a single Massachusetts town, it would create a template other towns could copy. A senior who bought a house 30 or 40 years ago for $150,000 and has seen it appreciate to $700,000 would owe tax on $550,000 of unrealized gain at even a 1% rate. That is $5,500 per year, due in cash, based on equity the owner has never actually turned into money. So, the main protection in Massachusetts is the Senior Circuit Breaker Tax Credit, available to homeowners 65 and older whose property tax bill is more than a set percentage of their yearly income. The credit has a maximum amount that changes annually and is claimed through the Massachusetts Department of Revenue as part of the state tax return. There is no filing fee. The credit is refundable, which means if the senior owes no state income tax, the state cuts a check. But the more critical filing is the local property tax exemption for seniors over 65, known as Clause 41. It is available in most Massachusetts towns. The amount varies, typically from a few hundred to a few $1,000s per year, and the form is submitted annually to the local board of assessors, almost always with no fee. Taken together, the circuit breaker credit and the Clause 41 exemption can offset from about $2,500 to $4,400 in property taxes each year. Now, I still owe you the answer to the question I posed at the beginning. There is one document you can file at a county or town office for less than $75 in most areas that effectively blocks the most aggressive equity stripping mechanisms in 4 of the 5 states I just described. That filing is a homestead declaration. In Massachusetts, it is called a declaration of homestead. In Illinois, it appears as the Senior Citizens Homestead Exemption. In Minnesota, it is known as the Homestead Classification. In Nebraska, it is the Homestead Exemption. New Jersey is the single state in this group without an equivalent homestead shield of comparable breadth. The Homestead Declaration is a straightforward county filing that marks the property as your primary residence and, in most states, protects a chunk of your equity from creditors and forced sale. In Massachusetts, that protection can reach into the hundreds of thousands of dollars. In Minnesota, it covers a broad amount of equity for a primary home on a modest lot. The filing cost in most counties usually falls between $35 and $75. Here are 5 steps to complete this week before any of these systems catch you off guard. First, confirm whether your state is on this list. If you live in Minnesota, Nebraska, New Jersey, Illinois, or Massachusetts, your risk is highest. In other states, similar protective filings exist under different names, and a senior homestead exemption is often the first place to look. A licensed real estate attorney or your county assessor can determine eligibility in about 15 minutes. Second, submit the homestead declaration in your county or town. For most seniors in the 4 qualifying states above, this is the single most valuable filing you can make, and it typically costs under $75. Once filed, it generally remains effective as long as you own the home and often extends to a surviving spouse. Third, ask your county assessor for a copy of your most recent property tax assessment. Compare the assessed value with recent sale prices for similar homes nearby. If your assessment is higher than the true market value, file an abatement request. The filing fee is usually $0, and a successful abatement often trims the annual tax bill by $400 to $1,200. Fourth, find out whether your state offers a senior tax deferral program. Illinois, Nebraska, and several other states let homeowners 65 and older defer property tax bills entirely, with the deferred amount recorded as a lien at low statutory interest to be paid at sale or inheritance. This way, the deferral can protect the retiree during their lifetime and protect heirs from losing the property in a tax auction. Fifth, arrange a single meeting with a licensed elder law or real estate attorney in your state. Typical rates run from $250 to $450 per hour. In that session, you can cover homestead filings, tax deferral options, surplus claim rules from any previous tax sale, and family transfer planning to secure equity in case of incapacity. In many situations, the savings from 1 year of properly filed exemptions will exceed the consultation fee. The underlying pattern across all 5 states is identical. Equity is not taken in a single dramatic event, but through a slow leakage of fees, deductions, and missed paperwork. So the defense is a stack of small filings, each usually costing under $100, that together safeguard the $4,000 or more that would otherwise disappear into the system. I